Everybody, and welcome back. My name is Rick Bosley. It's Wednesday at 12:15, so you know it's the Orlando Homeowner Show. So right now, we do not have any guests that are going to be on with us, but we do have a great session for you because I've done a lot of research. We've got content, and we are doing real estate by the numbers today. It's December 2020, taking a look at what we can see in the future, what's happened in the past, so you can be a savvy homeowner, home buyer, or home investor. So stay tuned. We'll be right back. All right, welcome back. Again, my name is Rick Bosley. This is the Orlando Homeowners Show, and if you haven't joined us or seen us before, we are live every Wednesday at 12:15 with content specifically for you, the Orlando homeowner. We say Orlando because that's where we do sell real estate, yet really a lot of this information is pertainable or applicable anywhere in the country. In the recent weeks, we've had a mortgage loan officer talking about what he expects in the rates. We've had a solar panel specialist, insurance broker talking about the insurance premiums, roofers. So if any of those contents are applicable to what you need or something that's happening in your household, make sure you like or subscribe at our Facebook or our YouTube, however you're watching this, and you can take a look there. Also, if you have any ideas for content of shows you'd like to have or guest speakers, please drop it in the comments, reply back to the email, and we'll make sure we can get it for you. We are live on Facebook and YouTube right now, so if you have any questions about something that's happening in your specific market or your specific situation, please go ahead and ask it there, because for 30 minutes, I'm going to be unplugged. I do have content to talk about, yet it's going to be really talking about things that are applicable to you. So let's get started right now. There you go. Hey, Jason, I can always count on you. Thanks for having us flagged. Everyone needs to be like Jason and go ahead and like and subscribe. And that way, when we're live, you can be like, stop what you're doing, or maybe keep eating because this is a good time for lunch hour. And let's go ahead and go live. Heather, hurry. Yeah, Patrick was awesome. Patrick's the roofer that we had on from Stratus Roofing. Talked about all sorts of conventional wisdom for as you're looking to buy a house. And it actually complemented nicely with the following week with the solar panelist. So Heather was awesome. Hey, thanks for that introduction, Heather. All right, so we're going to go into a little bit of talking about what's happening in the real estate market. So let me share with you. You know what? We're going to make it bigger. It's more important than I am right now. So here's the market pulse. This is what's happening in Orlando. Now, if you are listening to this audibly, I'm going to be having some attachments. So all the attachments that you're going to see here, I'm going to include with the link. And so you can download this for yourself, take a look at it later. And if you are listening to this in your car, then just drive carefully. And if it really strikes a nerve, mark where you're at, we'll be able to get to it. So let's take a look here of November 2020. Guys, something big really stood out to me. We call this a historic all-time low, right? This 2.70 as the average mortgage rate. The average mortgage rate. Let's historically look up the previous 2 years. All right, we are celebrating 3.2, 3.5. Last year was 3.6. It got as high as, where was our highest? 4.97 2 years ago. So 2 years ago, November was our historic 2-year high, and now it's our historic 2-year low. So go ahead and bookmark that because interest rates are stupid low right now. And if you want to go back, you can take a look at our interview with Dustin Owen. I think it was episode 3, and he talks about why and how they're going to stay low for the future. And I've actually got some information from Jerome Powell, who's the chairman of the board of the Federal Reserve, of what's happening and why that's happening. So, okay, so we take a look at the inventory. Let me zoom this back out a little bit so we can see the headers. Now you can't see it. All right, so we've got inventory up top. So essentially this 5,500 homes, this is what's for sale in ORA. Now ORA is an acronym for the Orlando Regional Realtors Association. So all the homes for sale, from the 1-bedroom, 1-bath condos to the mansions out in Windermere, there's 5,583 of them. There we have our stuff down the bottom. And so you do have a total of the condos, villas, single family. Now, of the total, 3,100 of them right here were new listings just in November. 33,000 got new contracts. So it was almost a trade-off, right? Of the new inventory that came in, 3,000 got off the market or got new contracts. And currently there's 4,600 under contract. This is in the pending status. That makes complete sense. It makes sense because 45 days closing is a month and a half. Well, if we have 3,000 in 1 month, 4,500 or so under contract there. Now, this is always good to know. Expireds and withdrawn, That's such a low number, right? If we're looking at 600, I'm going to get back to my face a little bit so you can see me. If we're looking at 600 homes out of 5,500 that are for sale, you're just over 10%, or not even. So what do we got here? 116 plus 517. Let's divide that out by 5,583. And so, no, let's try that again. 116 plus, this is live, people. We're live. That's 633 withdrawn or expired, and divide that out by 5,583. So yeah, 11%. The math was enough there. So if you're looking at all the houses for sale, 1 in 10 houses are not getting a contract. They're withdrawing or expiring. So really 90% of the houses are sellable based on price point or condition. 44 days in the market, that should be a historic low. Where are we at? Where do we see quicker than 44 days in the market? We don't. Houses are selling faster than ever with an interest rate lower than ever, so it's more affordable, and you've got to be able to get in there, get it quick. So when I take buyers out and they say, you know what, we're going to always offer 95 cents in the dollar, there's a good chance you're going to lose if you always offer a number, because the houses are going, well, the good ones are going fast. And money's cheap. So a house that you would have bought here 2 years ago at 4.5% interest rate that you can now get for sub 3, you can get a lot more house and you can make that higher offer. And I think that's what's really driving the prices up, is affordability is so great. So people, when they shop, you know, oftentimes it's going to be, I want to keep my mortgage, principal, interest, taxes, insurance under 2,000, under 1,500 and 2,500. How they get there, they don't really look at that number. If they can go get a $300,000 house under $2,000, they're great. Now, what's going to affect that? Well, taxes and insurance and principal, interest, down payment, all those things. But affordability is going there. Tommy Clem, what's up? Thanks for jumping on and saying hi to Jason, but not to me. Feel a little slighted there. So there's just a quick snapshot that says, as it sits right now, the market is as more affordable as ever, is moving faster than we've seen. And affordability is great, and it's definitely a seller's market. We're going to go into that with inventory. I'm going to skip down here, and no, I'm going to hang out here for a little bit, right up here. Specifically, I'm looking at this blue line up top. We look at this blue line up top. This is your months of inventory. This is Economics 101. There you go, Tom. He says hi. Thanks for jumping in. This is your Economics 101 supply and demand. Months of inventory says, well, we just saw, right? 3,000 homes under contract, 5,500 homes for sale. That gives you this number right here of about 1.7 months of inventory, so under 2 months of inventory. Now, look at the drop-off we've had, and this drop-off happened right here in May 2020. So the pandemic hit right here. We were tracking for this anyway, weren't we? This is where we were tracking. Pandemic hit. Let me change my color a little bit. And pandemic said, whoa, time out. Uncertainty of the market. Uncertainty of the market. So all of a sudden, people stop buying. They hold off a little bit. A lot of the homes went temporarily off the market. We had a listing that said, please don't show any houses. And so we figured out what the heck this is. And then right around May and June, at least it wasn't new, right? There's still a pandemic, and maybe it should have stayed out and we wouldn't be going what we're going through. But right now, everyone kind of got back to normal and said, I need a house. We're moving on. Yet the trend line was tracking still to be right down here, and it caught right back up with itself with months of inventory. Now, months of inventory happened really in the last economic recession in the 2007, 8, 9, 10, 11, 12. Builders stopped building to get us where we need to be, which is healthy, which isn't even up here. I'm going to draw it right here. When you look at months of inventory of a buyer's market versus seller's market, right now we're in a seller's market, right? And a seller's market is anywhere from 0 to 5 months of inventory. So what does that mean? Again, we're right up here. Months of inventory says how many houses are currently for sale and how many are turning over every month. So as long as we're below 5, sellers have the leverage in terms of negotiation, and prices will go up. This is just what's going to happen with supply and demand. Now, if we are from 5 to 7 months, this is balanced. historically, we don't hang out balanced very often. You're going to whip right through it and get right over here to 7 or plus months. And 7+ months is when you get over to a buyer's market. We went into this more detail when I had Ray Lopez on last month, and he keeps these market pulses, these reports here, all the way back to 2010, when we were in the mid to high 20s of inventory, of 30,000 houses for sale and 2,500 or 800, I think, was the lowest monthly sales. And that was way up here in this buyer's market. Well, what happened? Prices dropped. So if you're wondering or thinking this pandemic is going to make the prices drop, I respectfully disagree, because real estate has not been impacted to that level by the pandemic, because if anything, people are at home more and they're making more housing decisions. What's happened is the Federal Reserve has kept the interest rates low to keep affordability high to help stimulate and boost that economy. Let me jump that over to you guys, and I'm going to share with you this press conference, and I'm going to pull it up right here. Jerome Powell is the chairman of the Federal Reserve, and I've already did the cliff notes of this. There's 24 pages, so get tight. Now, I'm not going to read you all 24 pages. I will put this as an attachment, so if you want to do it, or if you'd like the YouTube link of what he said, if you're more of a listener and watcher than a reader, I'll also attach the YouTube link down in the comments below. That way you'll have the YouTube link to this. But here's what's interesting with the economy, right? The real gross domestic product rose at an annual rate, in fact, 33% higher than in the third quarter. And so it starts off with the economic activities continued to recover from its depressed second quarter level. That's when we got hit, that second quarter, just like when you saw that spike up in inventory. That second quarter was what was impacted by the economy the hardest. Everything else has been, let's go recover. Household spending on goods, especially durable goods, have been strong and moved to its pre-pandemic level. People are back to consuming goods, especially because they're at their house more, right? So their employer no longer is doing the toilet paper or the soap or the pencil or pens. They've got to do it. So household spending is up. However, spending on services remain low because services usually require gathering, like travel and hospitality. Now, when I say travel and hospitality, viewers, right now, that is Orlando. I'm describing Orlando, so we're still seeing it very low there. Tommy, you said since inventory is low, we're in a seller's market. How did COVID pandemic impact new home building and community developments? It hasn't. Well, yes, it has. So his question was, we're in a seller's market, inventory is low. So by that, we would say, then builders just go out there and build. Just go out there and create more. Well, with everything that's happened with this economic, lumber is about 3 times more expensive than it was this time last year. So it's actually crippled the building process because of that. Builders are building still at a rapid rate. You look at what's happening in Oviedo at Horizons West and Winter Garden. Horizons West has I think it's 15,000 homes over the next 5 years. That's their plan, and they're just popping them up. And we've sold, just in the last 3 or 4 months, we've closed on 3 new construction. So buyers are choosing new construction because it's low, but the developers with 3 times more expensive in lumber is affecting their margin, their prices as well. So, but at the end of the day, for us to get back to a balanced market, we need about a 30% surge in inventory. That would get us to where we have. If we added just 30% more, and it's just not happening, we can't outbuild it. Now, here's the other thing with that, and this is from a podcast I listened to with the Brian Buffini show. People now, especially that the employers are allowing more and more employees to work from home and virtually, they no longer have to be in their city or their state. My brother and his wife live in Washington or Seattle at Amazon, and they've been working from home since March of last year and will indefinitely, at least until June of 21. That's a full year, almost 2 years of working from home. So he's down here in Florida for the holidays, and I'm pretty sure they're staying through March, because if you want to be in Florida in January and February, or Seattle, Washington, and they're able to do it because they're working from home. So what's happening with that is, I don't know where I was going with that. I went to people are able to make more choices with their houses there. Did I answer that question, Tom? I think I did. Okay, so we're going to get back to this as we go through here. So we mentioned hospitality and travel. They're not spending as much, and that's Orlando's. The Orlando economy is still hurting, obviously, through iDrive and Disney and Universal and everything else out there. This is where he talks about, and this is not a real estate article, this is a Federal Reserve article. The housing sector is fully recovered from the downturn. It's fully recovered. We saw that on on this chart right here. We saw the full recovery. There it is, right? Now, the full recovery says there's confidence buying still. And so it's been that full recovery in the downturn, which supported in part by low mortgage interest rates. Overall, economic activities remain well below its level before the pandemic. Now let's talk about unemployment. Unemployment's a huge part of the Federal Reserve and the gross to the GDP. Nearly half of the 22 million jobs that were lost in March and April have been regained. Now this is nationwide, right? So now we're looking at that. Unemployment rate declined over the past 5 months. However, it remains elevated at 7.9%. So nationwide, it's at 7.9%. We'll call it 8% unemployment rate. Now let's look at, I've got an article here. Where did I put it? Okay, I put it, let me find it, and then I'm going to pull it up. Here we go. So here's the Orlando unemployment rate. Let's take a look what's happened in Orlando. So in 2010, which is the bottom of our, let me do that, the bottom of our recession, and let me view and zoom it. Let's go to 200 and see where we're at. Hey-oh, that's a little bit too big. 150. We'll split the difference. So in 2010, when I started in real estate, it was January 2011. Here you go. Anyone want to take a guess in comments what the average price point in real estate was in January 2011? I'll let it sit there for a little bit. Comments, average price point January 2011. We'll give it about 5 seconds for see who wants to play. Yeah, it was under 100,000. You could buy a house on average under 100,000. And this is when the hedge funds were coming in, and unemployment was 11%. And you can see that was about the high, right? When we're looking, okay, the year before 11.5, but we never saw double digits after September 2011, and the economy continued to improve, right? That goes to December. Now, as we look at these past 3 and 4 years, our all-time low was 2.5%, and that's just a year ago. So a year ago was 2.5% unemployment rate. Unemployment rate, when they look at it from a national level, 6% is healthy. 6% says anyone who wants a job has a job. Some people had a job they didn't want a job according to this because it was 2.5%. This is I say this is nationwide. This is Orlando. This is Orlando's data right here. Looking good, looking good, looking good. Welcome COVID. Big uncertainty. We're recovering, and we are consistent with what's happening with the national statistics of 7.9 or 8%. So unemployment is recovering. It is not there, although 6 is healthy. Jerome Powell also mentioned interest rates will stay low until he sees the improvement economically that they need, until he sees unemployment sub 6, until he sees other factors. So here's another factor that he's saying of why he's going to keep like he controls it. I guess he kind of does. Why it's going to stay low. Let me get back to this. Here we go. So there you go, inflation. On a 12-month basis, inflation remains below 2% longer run objective. They want 2% a year for inflation. Keep scrolling, keep scrolling. With regards to interest rates, we continue to expect it will be appropriate. It's scrolling. Why are you scrolling? With regards to interest rates, we continue to expect that it'll be appropriate to maintain the current 0 to 0.25% target range for federal rates. Now, when the Fed came out back in June or May of 0%, we get all sorts of calls that saying 0% interest rate. No, that is the Fed national funds that then translates and correlates with that sub 3 or low 3s. They're going to keep it there until the labor market conditions have reached the levels consistent with the committee's assessment of maximum employment. So essentially, they're going to keep low interest rates until they start seeing 2% growth of inflation happening again, until they see unemployment getting below 6. So they're still going to keep affordability for housing low until we can recover otherwise. So you can take a look here. The majority of this article that I've just read through is Q&A. They go through probably 4 pages of the speech and then Q&A after that. So here's something else it was interesting to hear and listen to. I'm going to escape out of this because I've got it happening. There we go. Just cross you off. Is the rental market. Now, in real estate, you've got home buyers will move every 5 to 7 years. If you own a home, statistically, in 5 to 7 years, you will be moving up, moving down, moving out, moving around. Some of you guys will do it in less than, some of you will do it more than. Renters are very fluid. They're closer to 18 months. It's common for a renter to be month to month or annual, and then they're going to switch and annual and switch. So the rental market's very fluid. So I wanted to take a look at what was happening with the rental market. And there we go. So here's the rental market. And the data, I was looking for something, and I wasn't sure what data was going to tell us, but it tells us something. So in 2020, there were 2,653 homes, and this is just for Seminole County, right? So this is just Seminole County, Florida. I know that you guys might be looking at this, not Seminole County, but it's a good snapshot for what we've got. The average rent was $1,564. As we go down to the previous 12 months, you can see there's only 2,000 in 2019 and just over 2,000 in 2018. And so that shows that there's 28% more homes that rented, at least through the MLS, this year than the previous 2 years. Yet the average price of $1,564, $1,545, and $1,568 remained the same. I was curious with the increase in the amount of rentals of 28% higher. 2017 and 2016 was actually 2,100, 2,219. So when we look at the rental market, that's the more fluid. That's going to be the leading indicator. And what I've been seeing is rental markets are increasing, at least for the same price point of the most competitive buyer's market, seller's market, excuse me, the housing market. So if you're wondering, what do you do for your real estate portfolio? This is Rick coaching or helping you to build wealth as much as you can. Get in real estate. When the market is down, real estate keeps going up. We've seen how this market has been rarely or a little affected by the pandemic. In addition, year over year, the housing market volume increased by 4%. So if natural inflation went up by under 2, but the housing market went up by 4, you're winning. In addition to that, when you invest in real estate, you're actually able to get 3 or 4 different ways in which you can increase your ROI or your cash on cash. Let me explain that. So if we go right here, and let's say you get a $200,000 house and you want to buy it as an investment property, right? And with that, you take 25% down. So it's going to cost you about $50,000 to get into it. And so that's your down payment. If you were to do 50,000, that means you're going to borrow 150,000. Well, with the interest rates like they are of 150,000, you can expect your monthly principal, interest, taxes, and insurance to be around $900. Except for this rental of 200,000, which might be a 3.2 or a 3.1.5, right? you can get rental anywhere from, I'd say, $1,300 to $1,500. And so now cash on cash, you're making a difference of anywhere from 400 to, oops, let's do that. Anywhere from 400 to 600 per month. Now 400, 600 per month, let's just split the difference and call it 500. That's going to be $6,000 per year. And it took you $50,000 to get it. So 6,000 into 50 says you're getting a 12% return on your 50. Now, in addition to what you're getting just with that cash on cash down payment to there, you're also increasing, right? Last year was a 4% increase. Oops, got a little wonky there. Last year was a 4% increase. And so let's go ahead and add 4% again, although we know that the market's going to go higher. And so now you're at 16. And when your tenants are paying $900, a good portion of that, at least half right now, is going towards your principal. And so now you no longer owe $150, you owe $149,550. And every month they're reducing your principal. So when you sell it, you get that equity back. So we think about cash flow, really the only money that you're not going to keep from this rental is what you're paying in interest, taxes, and insurance. And with interest being so low right now, that money is going to come to you on a monthly basis, or that money is going to come to you when you go ahead and sell the house down the road. I've talked with a lot of homeowners who are looking to sell, and they can afford to get a second house. Lenders can actually use the rental market, the fair market rental value, give you about 80% and apply it towards your debt to income. So you might go, there's no way I could apply or be approved for 2 different loans, but you could because of that ability to use the rental market. So take a look there. If you're thinking about getting another house, can you hold on to your house, become a landlord? Yes, it's complicated. Yes, it can get messy, yet the ROI and the cash on cash can be fantastic. And my goal and my mission is to help my employees, my customers, my consumers, vendors, partners build wealth through real estate and to make smart economic decisions. Everyone I've talked to says the market's not going to turn down. The market's going to stay hot. We are going to have a stronger year in real estate in 21 than we had in 20. And so if you're thinking about waiting for the market to turn, you might be waiting for a while. According to everything, rates are going to stay low, and Orlando's a hot spot for where people want to live. It's 12:42. We had a couple people on here viewing. If there are any questions or comments, I do want to offer that there are different pockets of the market, right? I like to use the comparison of how do people feel in a hospital? Well, it depends. Are you in trauma? Or you just deliver a baby? So trauma says, I can't feel my legs, and delivered a baby says, I'm elated with joy. So it depends where you're at in the hospital to say how you feel, and it depends where you're at in the real estate market. The price point that you're looking at, luxury versus entry level, different cities, different zip codes, different style of homes. If you'd like to know specifically what is the market doing for your hyper local pocket, reply to this, comment to this, drop us a line, drop us a text. You can see, you can get a hold of us right here. This will go to myself, my assistant Jennifer, or our sales agent Georgette. And either one of us can take your call and say, look, here's what's specifically happening in your area, in your hood. Thanks for joining us. This is another episode of the Orlando Homeowner. I trust you found it to be valuable. If there's any questions you have, let us know. Don't forget to like and subscribe, and we'll see you next week because we're going to keep doing this every Wednesday at 12:15 to 12:45. Thanks again for joining, and we'll talk to you soon, everyone. Take care.